Hello everyone, this is Sector and welcome to a new video of my training course. In this video I'm going to be talking about one of the main elements of my trading system, that's the dynamic area of support and resistance, which is basically the area, the band between the 30 and the 50 simple moving average of the close, right? This is in this chart, in the chart that you are seeing right now, the 30 simple moving average is marked in red, in green, the 50 is marked in red, and the 100 is marked in blue, while the dynamic area would be this band, okay, this area within the 50 and the 30. All right. In my opinion, it's a very important area. And as a trend trader, I always like to keep an eye on the dynamic area, because it's a good indicator as far that we can use to to read the overall health of the trend. Anyway, I'm gonna now be showing you some different charts in different time frames and different currency pairs, so you can see the dynamic area of support and resistance in play. The reasons also why I'm showing you different charts and different, like I said, currency crosses and different time frames, is so you understand that this is a universal principle. It applies to all the time frames, and basically, it's as why I consider it one of the main elements of my trading system. All right, okay. First of all, there is one requirement that we need to make sure that actually applies to that particular chart that we are looking into at that precise time, before trying to analyze or trying to take any trade from the dynamic area of resistance or support, and that requirement is that there must be a trend in place. All right. I was just mentioning how the dynamic area of support and resistance is the area between the 30 and the 50. Well, that's not totally accurate. Okay, it's a dynamic. The area between the 30 and the 50 in trending markets, and only in trending markets. That means that let me scroll back in my chart, for example. Okay, all right, right here, right now I am showing you a range bound market. Okay, very clear range bound market. Prices basically whipping up and down, and then up and then down and up and down again. Basically, it's moving sideways, or at least it's definitely not moving in any particular direction. There is no particular bias in this chart. Okay, while in this case, the area between the 30 and the 50, meaning between the green and the red moving average, holds no significance whatsoever. All right, as you can see, this area is being breached up, breached down, breached up, breached down once again, so on and so forth. It has no relevance whatsoever in non-trending scenarios. Okay, so whenever you are to apply the principles I'm going to be showing you on this chart, make sure that first of all you are indeed looking into a trending market, okay, into a trending chart. As we saw on the first video of this trading course, as far as I am concerned, a trending chart, a trending currency pair is that shows my three main moving averages, okay, the 30, 50 and the 100, 30, 50 and 100, all of them in order, all of them parallel to each other, price nowhere near the 100, price spending most of the time in the right side of the 50, etc., etc. Okay, so like I say, always make sure that you are actually looking into a trending chart before trying to apply the concept of the area of dynamic support and resistance. Otherwise, like I say, this area holds no relevance whatsoever. All right. Okay. Most of the time in trending markets, okay, we've determined already that we are in a trending in the trendiness scenario. In this type of market conditions, most of the swings, at least in a healthy trend, are contained, okay, or let's say they bounce off this area between the 30 and the 50 moving average. The reason as of why I like to keep an area on the dynamic area of support and resistance, basically the reason as of why it works is because institutional players like to keep an eye on this area, okay, on these retracements, in order to adapt to their positions. All right. I'm talking about, of course, large investment banks, hedge fund managers, etc., etc. You know, the people who trade volume enough to actually move the market. As you guys know, Forex is an enormous market, and you definitely need large capital to have an impact on it. Okay, and that's only investment banks and institutional players have the capacity to have their individual positions to have any sort of impact on these large markets of Forex. So these guys, the large traders, they basically are all of them trend traders themselves, and well, of course they all follow different trading approaches, but basically they sell pullbacks in a downtrend, or they buy retracements in an uptrend. Okay, let's say you have an uptrend, and they basically buy the pullbacks. All right, price retraces back, okay, and they adapt to their already long position, okay, and therefore price moves forth into a new swing. All right, then upon the pullback they adapt to their position, and so on and so forth. Okay, same thing as in a downtrend. And I know for a fact that they do like to keep an area on these retracements areas to around the 30 and the 50 simple moving average to adapt to their position. All right. So let's say that the area between the 30 and the 50 moving average is a decision-taking area. Okay, it's an area that there are going to be loads of enormous limits orders. Okay, either sell or buy limit order. Depending on what side of the market you are, of course, depending on whether you are in an uptrend or in a downtrend, and you know that price is bound to react in some way to that area. All right, if let's say we are in this clear downtrend, all right, and price pulls back to the dynamic area of resistance, in this case, since we are in a downtrend. If we have enough limit orders stuck up at this area from different institutional banks, from different hedge fund managers, etc., to create a new swing, those limit orders will be stuck up, like I say, in this area between the 30 and the 50, and therefore, bang, a new swing will be created. Upon the next pullback, same thing. If there are enough orders at this part of the chart, at this junction of the chart, a new swing will be created. Okay, always in the direction of the main trend. Otherwise, if the institutional players have lost interest in this chart, in this currency pair, price, in the other hand, will continue moving up. All right. So that's basically the reason as of why I like to keep an area on the dynamic area of support and resistance. It's a decision-taking area, an area where if the trend is to survive, most of the swings should spring off that area. All right, should be created off that area, and therefore 95% of the price action will be contained at the right side of that area. Okay, let's assume this is let's picture the dynamic area as a boundary, all right, as a frontier. If the trend is to to still be in place, price, or at least 95% of the price action, should be contained on the right side. In this case, since we are in the downtrend, it should be contained on the lower side of the dynamic area. Okay, as soon as we breach this area, all right, as soon as we break above and we begin to have, you know, enough price action above this area, well, the trend is definitely weakening, all right, or even, you know, finished. All right, now I'm gonna be showing you some charts now that I have explained the basic, you know, the theory, let's say, behind the dynamic area of support and resistance, and so you can, you know, see by yourself how price reacts of this area, always in trendiness scenarios. Okay, like I was saying before, if there is no trend, there is no point in having a look at the 50 or the 30 simple moving average, because they are irrelevant. Okay, they only work in trendiness scenarios. All right, there we go. First of all, in this case, the chart you've been seeing all throughout this video is the USD against the CHF in the 1 hour time frame. All right, upon this level, okay, upon this moment, this time of the chart, the moving averages fall in place. All right, as you can see, the 30 is below the 50 and the 50 is below the 100. Moreover, price is nowhere near the 100. Okay, all of them are parallel to each other, etc., etc. Fine, we are in a trending scenario as per my trending conditions. Okay, from this moment on, I am liking my main trading strategy will be to wait for pullbacks, all right, to the dynamic area of resistance, and from there I'm going to be searching for short entries and only for short entries. Okay, of course, I'm not gonna enter any trade just as price retraces back, all right, just as price retraces back to the dynamic area of resistance. I am not just gonna, you know, enter short in the market out of the blue. Okay, I'm gonna be searching for my entry signal will be basically triggered on the short time frames upon a reversal price formation here. Okay, I don't want to get into that. I explained that. I explained the reversal formations in chapter number 3 of this trading course. For the time being, I just want you to, you know, I just want you to more or less have a picture of how my trading system goes as far as the entry, and actually more than the entry, at as far as where in the chart I would search for those entries. Okay, all right, so. Like I was saying, we have a downtrend, right, guys? In this downtrend, we have a pullback back to, well, first of all, we had this pullback, then we had another swing down, and now another pullback to the dynamic area of resistance. In this case, I would be, like I said, searching for reversal formations in the short time frames in order to enter short in this market. If I do get this, if I do get a reversal formation on the short time frames, I would enter short. Always and only short, since we are in a downtrend, and then I would ride a price for a new swing to the downside. Then I would, of course, set my final targets, okay, which are explained on chapter number 4, and I would exit taking my profits off the table, okay, cashing this on this trade, and then wait for the next opportunity. The next opportunity comes here. Okay, we have another retracement back to the dynamic area of resistance. In this case, we just peep the 30 simple moving average, but nonetheless we do get there. All right. All right, good, fair enough. Then I would, once price retraces back, okay, I usually, one of, a trick of mine is to always set a sound alarm few pips below the 30 simple moving average, right, before reaching the 30 simple moving average. So whenever I have a trend in a scenario, like I say, I place my sound alarms 10 pips before that, 10 pips before the 30 simple moving average, so I get warned whenever price retraces back, so I can follow price action in real time. But like I say, I don't want to get into that. I explained that on the chapter number 3. For the time being, I will just say that In this case, upon having taking this short entry and hopefully cashing in some profit, I would wait for the next opportunity. This next opportunity comes here, retracement. Then I would zoom once again into the shorter time frames. Once again, I would search for a reversal formation at that level, always looking for bounces down of the dynamic area of resistance. Okay, we have the retracement. I would search for a bounce down in the direction of the main trend. Bang, trigger short entry, write it down. Next opportunity, same thing, retracement up to the dynamic area of resistance. Okay, search for reversal formation. If it does happen, if I do see a reversal formation, if we do get a bounce down of here of that level, trigger your short entry, bang, write it down. Next thing up, okay, next swing up, next pullback, same thing, pullback back to the dynamic area of resistance, zoom into the short time frames, search for a reversal formation. Do I see that reversal formation? Do I see a bounce down of that level? Enter short, bang, new swing down. Okay, you are trading high probability chances. First of all, you are trading in the direction of the main trend. Okay, that's crucial. All right, guys. As I was mentioning on the first video, if you do not trade in the direction of the main trend, you can forget about achieving any type of consistency as far as trading goes. Not only forex trading, it doesn't matter whether you're trading forex, I don't know, stocks, futures, oil, corn. No matter the market you're trading, the only way to achieve some sort of consistency in this business is to trade always with the trend on your side, okay, with the moving averages pointing in the on the trading direction, and that's the way I personally do it. Okay, like I say, it's the only way to make sure that you are stacking up the odds on your side. All right. So, like I say, these are high probability chances. First of all, you have the trend on your side. All right. Second. Second element on your favor, you are not just entering at any time, you're just not taking entries out of the blue. You actually wait for a pullback to an optimum area, okay, to an area of decision taking, to an area where if the trend is indeed going to continue, if the trend is indeed to trend on, it will be from this area, from the area between the 30 and the 50 in most cases. All right, like I say, you're not entering here or here. I mean here or here or here. No, none of that. You're basically waiting for a pullback to the optimum area. Once you get your signal, bang, you enter short. Okay. Always you wait for the perfect time, the area between the 30 and the 50 simple moving average. All right, so that's two elements of your favor: the trend and the dynamic area of resistance. Moreover, third element on your favor, you are just not entering right as we retrace back. All right, I never enter. I never, let's say, place a sell limit order somewhere around here. I never do that. What I do is, upon the retracement, is if I see that price begins to curl around, if I do get that reversal formation, which, like I say, I will get into that on the chapter number 3 of this course. If I see that price begins to curl down upon bouncing from that level, then I enter short. That's my confirmation. All right, like I say, upon a retracement, I don't quite sell right there. No, sir. If I will only enter short if price begins to curl down in here. Okay, once I get the confirmation that the dynamic area of resistance is indeed holding price and price begins to curl in the direction of the main trend, and then I will enter short. Okay, same here. I don't short here. I wait for the turnaround, and there is where I would enter short. Okay, and write a new swing to the downside. All right. So you are stacking odds on your favor. At the end of the day, trading is a probability. It's a probability game. All right, guys. I know you've probably read over the internet that trading is complicated. Trading implies many different super complicated systems, super complicated indicators. That's not the reality. Okay, trading is all about mathematics. It's about probabilities. Okay, money management. Are you trading with the odds on your side? All right. Are you trading in a trending scenario? Are you trading moreover in the direction of the trend? Okay. Are you trading at the optimum area of the chart? Are you waiting for the confirmation? Okay, are you waiting for the confirmation that the trend is indeed holding and a new swing may be creating? Okay, maybe about to be created actually. Okay, you are basically, like I say, stacking up chances, odds on your side, and that will increase your win-loss ratio. Instead of scoring a 50-50, okay, you will be trading on a 60-40, 70-30, 75-25, 80-20. All right, you are stacking up chances on your favor. All right, and in order to do that, you've got to analyze your chart. You've got to analyze whether you are trending, whether you are trading at the right time of the chart, etc., etc. Let me now show you another chart. Okay, in this case, we've now just seen the USD against the Swiss franc. That's American dollar against the Swiss franc on the 1 hour time frame. Now I'm going to show you a complete different currency pair in a complete different time frame. Okay, this is the sterling pound against the American dollar, what we usually call in the forex market the cable. Okay, we call the cable for this currency pair on the weekly chart. All right. Very, very long-term chart. All right. Now let's analyze this chart. Why not, guys? All right. First of all, how are these moving averages plotting on my chart? Well, first of all, I see they are all in order, aren't they? 30 is above the 50, and the 50 is above the 100. Good. All right. Moreover, I can see that they are all pointing in the same direction. They are more or less parallel. All right. More or less parallel, especially the 30 and the 50, which are the two most important ones. Price is nowhere near the 100. Okay, you see, this is the 100 moving average, and price is very far away from it, isn't it? Okay, and and moreover, price is swinging harmonically off the dynamic area of support. All right. Swinging harmonically off the dynamic area of support, isn't it? All right. Then we are in a clearly trending scenario. Yep, it's certainly a trending scenario. So in this case, now that we've recognized that we are in a trending chart, okay, now the area we want to keep an eye on is the area, remember, between the 30 and the 50 simple moving average. All right. And especially the bounces, okay, the pullbacks to that area, in order to confirm or to verify whether we get a bounce off that area. And we actually do. Okay, just have a look at the chart. Every time price, the cable in this case, retraces back to the dynamic area of support. By the way, this is the dynamic area of support. Since we're in an uptrend, it will be called resistance if we were in a downtrend. Okay. All right. Every time, as I was saying, every time price pulls back, right, to the dynamic area of support, all the enormous amount of limit orders, okay, buy limit orders in this case, in order to go long, are enough to hold price below. So every time price goes down, like I was saying, this is a decision taking area, and price reacts of that area. Okay, pullback, reaction, pullback, reaction. All right, it happens many times. That means that this is a healthy trend. Okay, it's a trend that's carrying enough momentum to the upside. Okay, every time the bears manage to pull price down to the dynamic area of support, the bulls come in play. The bulls regain control of the situation and bang, push price to the upside. Okay, another pullback. The bulls once again come in control and, basically slap the bears in the cheek and bangs goes to the off it goes to the upside. Okay, it's always important to make sure that upon every bounce of the dynamic area of support, we score new highs. All right, we breach the previous high, then we have a retracement, we bounce off that area and we score a new high. Another retracement, off it goes, scoring new highs. Another retracement, off it goes, scoring a new high. Okay, always remember, guys, that from a very basic point of view, a trend is nothing but a consecutive string of higher highs, all right, and higher lows. If you see that your chart is making higher highs and higher lows, all right, you are basically uptrending. Okay, as I was explaining on the first video of this course, just making higher highs and higher lows, it's not enough, in my opinion. You want the moving averages to plot under certain conditions in the chart, as usual, all of them in order, all of them parallel to each other, etc., etc. So in this type of trendiness scenarios, like I say every time, if when price pulls back to the dynamic area of support, and if it does not breach it, all right, if it does not breach it, meaning that if this band actually is strong enough to hold price, all right, upon the retracement, okay, upon the retracement, if it's strong enough to turn price around in the direction of a very clear trend, entering long there would have been a high probability trade. Next retracement, same story. We reach the dynamic area, we see price beginning to turn around. This would have been a nice long area, or a nice area to enter long for another swing up. All right. That's basically what I do in my usual trading approach. I search for a trendiness scenario. All right, I keep an eye on my dynamic area of support. Then I wait for a pullback to that area. All right, I get a pullback to that area, and then, like I say, I read price action in the shorter time frames. If I see the beginning of a retracement, bang, I enter long there, and I ride it for a new swing up. And the next swing over, the same thing. Is the dynamic area holding the retracement? If it is, bang, there I go. I want to be long because I am in direction of the main trend. I am buying, I am going long at the right time of the chart. I'm not going long here or here or here. No. I'm going long at the right as price turns around, as price pulls back and then begins to curl around in the direction of the main trend. That's the beautiful area you want to enter long from. All right, so like I say, keep an area on the dynamic area of support when you see a trending scenario as per my moving average conditions, because that's a very strong area. All right, it's an area that price is somehow bound to react of it, either to breach it, okay, and if it breaches through, then you don't want to search for long entries anymore. Let's say this retracement didn't stop here, but instead it went all the way down here. That means that the dynamic area of support was not strong enough to hold the retracement, and therefore you don't want to be searching for long entries anymore. All right, as long as this area begins to holds price and price begins to turn around, and you zoom into the short time frames and you see a reversal formation as explained on chapter 3, you're good to go for a long entry. You are trading a high probability trade. Right, next, let me show you another example. In this case, the USD against the Canadian dollar. Okay, I'm gonna make this very quickly because, well, it's basically the same thing. First of all, we analyze whether we are in a trending scenario or not. Yes, we are. All the moving averages in the same direction. No crossover whatsoever. Have a little bit of snaking around there. They get close to each other, but nonetheless there is no crossover whatsoever. Price nowhere near the 100. Have a look where the 100 is the blue line, remember, and price is, you know, very far below there, etc, etc. Okay, in a trending scenario, then what do? We keep an eye on the dynamic area of support and resistance. As usual, we wait for price to reach this area once again and have a look. Just look at the chart, okay? You don't have to believe me. Just look at the chart. In fact, just look at your charts. Go ahead on your own charts. Search for moments where all the moving averages were falling in order, pointing in the same direction, parallel to each other, etc., etc. And when that happens, see the reactions of the dynamic area of support and resistance. If price breached through, you would have taken no entry. If price, upon touching the dynamic area of resistance, begins to curl around, you are indeed about, or you could be about to be trading a high probability trade. Okay, like I say, don't trust me. Just go to your own charts, plot the 30, the 50, and the 100 simple moving average. Scroll back in time, search when they fall in order, and when they do, mark the area between the 30 and the 50. If that area holds, okay, if when price retraces here, holds, I mean, of course, if price breaches through, search no more, okay, there is no trade to take there. But if it does hold and price begins to curl down in the direction of the main trend, just run some, let's say, some demo trades and see what would have happened. You would have made money. You would have made money in the long term. Perhaps you may lose one trade. Of course, losing trades do happen in trading. Okay, they are unavoidable. I score many losing trades. You can browse through my blog and you will see that I indeed score losing trades here and there, just like any other trader. But as I was saying before, trading is all about probabilities and making sure that in the longer term, in the long run, the winners will outnumber the losers. Okay, and that will indeed be the case if you trade in the direction of the trend. If you wait for a price to pull back to the dynamic area of resistance, and then you trade as the turnaround begins to take place, and then you write it down. For example, here we got a pullback, but we didn't reach the dynamic area of resistance, did we? Then this would then have been a good entry. Patience is important when it comes to trading, guys. You're not supposed to trade every single setup you see in front of your charts. Okay, you've got to wait until all the right conditions actually apply. All right. In this pullback, we did not get quite to the dynamic area of resistance, did we? Okay, so if you trade it as this was turning around, let's say there, that would have been an aggressive trade. I personally am a conservative trader. That depends on whether you want to be an aggressive trader or a conservative trader. I myself, I am a conservative trader. I don't mind missing out on few swings, like for example on this one, as long as my win-loss ratio remains high, meaning that as long as those trades that I do indeed take, they carry a high chance of actually becoming a winning trade. All right, and that's basically what I'm trying to teach you here. Okay, downtrend, retracement back to dynamic area of resistance, begins to curl around. Let's say trigger your short entry there, bang. All right, same thing, retracement back, begins to curl around, enter short, bang. Here no trade, guys, we did not breach the dynamic area, but here we did, begins to curl around, short, bang. All right, as far, like, once again, I've repeated 100 times, sorry about that, guys, I'm quite heavy here. Don't worry about the actual entry signal. I will explain that on chapter number 3 and chapter number 2, if I am correct. If I'm not mistaken, chapter number 2 and chapter number 3 displays all about entry. So as far as this video is concerned, don't worry too much about entries, but just mind the swinging, the harmonic swinging, no trade here, the harmonic swinging formation, alright, and keep an eye on the dynamic area of support and resistance, alright? Okay, another chart, why not? Another uptrending chart, beautiful uptrend with those moving averages nicely parallel to each other, nicely pointing in the same direction, price steering clear of the 100 moving average, etc, etc, and in this case price indeed holding, if we draw a solid band between the 30 and the 50, we can clearly see that price is holding, that band, the dynamic area of support in this case, it's clearly holding price above, and if it does, it means that this is a healthy uptrend. We have a quick pierce below here and another quick pierce below there, but it's a quick pierce below, but immediately after it shoots back up. That's alright. Okay, markets are not perfect. As long as you don't begin to get 1, 2, 3, 4 bars closing below the 50, as long as it's just a quick dive below, but immediately after, bang, it goes back up, then you are alright. As long as you don't begin to get multiple bar closes below the 50, as long as price gets nowhere near the 100, that is okay whenever it begins to turn around, alright? Alright, in this case we can clearly see the same thing. We are in an uptrend, price retraces back, as soon as it begins to curl up, you're good to go for a long entry. Same thing, another swing up, you make new highs, retracement reaches the dynamic area of support, price begins to turn around, trigger your long entry, bang, another swing up, you make new highs, retraces back down. We don't touch the dynamic area of support, guys. You see that? We didn't touch it. The retracement was not deep enough. If it's not deep enough and you decide to take an entry, that's an aggressive entry. You can, it's up to you, but please be aware that you are being you are definitely being more aggressive than I am myself on my own trading, but I respect every type of trading. In my opinion, the way I like to trade myself, it's to if there is no pullback to the dynamic area of resistance or support, there is no trade. Just that simple. In the next swing down, we definitely get the retracement back into this area, don't we? Well, it does hold it. Okay, price does not breach through. We get no closes, no multiple bar closes below the 50. Price gets nowhere near the 100. So yep. Indeed, price, the dynamic area of support is holding price above. As soon as this thing begins to turn around, as soon as we see a reversal formation in the short time frames, enter long, and then you enter long, and we go through a period of consolidation. Seems like the market lost a little bit of momentum there, a little bit of steam, but nonetheless, even though we lost momentum and we were moving sideways, please keep in mind that the dynamic area of support was never breached. In fact, the moving averages, all of them continued pointing up, continued in order. Okay, they kept on being parallel to each other, no crossover whatsoever, etc, etc. The trend is still intact. Okay, the trend is still in place. It's just that we are going through let's say a momentumless part in this trend, but the trend is still indeed there. Alright, it is still indeed there. You see, price never broke below the dynamic area of support. Alright, never went near the 100 moving averages, and as soon as finally we gain some momentum, alright, bang, sure enough, the trend muscled price into the right direction, meaning up in this case, since we're in an uptrend. That's the beauty of trading in the direction of the trend. Okay. The trend, there are more chances that sooner or later, even though you may go through an area of consolidation such as in here, all right, or here, there are higher chances that the trend will eventually push price to the in the direction of the overall market sentiment, just as it did here. All right, it's just a matter of waiting, of spotting that you are in a trending scenario, and then waiting for the right time and the right junction of the chart in order to search for entries in the direction of the main trend. And that area, in order to search for entries, is of course the area of the dynamic area of support. All right, I'm going to show you one last chart. This video is getting too long already, so I'm going to show you one last chart and wrap it up for this topic. In this case, I am showing you the euro against the Swiss franc on an intraday chart, okay, on the 30 minutes chart, and just to show you that. Just as before, remember, I was showing you a chart on the weekly time frame. In this case, I'm showing you the 30 minutes. This concept works no matter the time frame, no matter the currency pair. All right, it works. It's universal because it's based on trends, and trends happen both in the longer time frames, also in the intraday price action. Okay, it happens no matter the time frame, no matter the currency pair. So these concepts that I'm explaining on this video, like I say, are universal. All right. All right. Well, we open up our chart, in this case the euro against the CHF on the 30 minutes chart. First thing of all, as usual, we analyze the moving averages. All right, the 30 below the 50, the 50 below the 100. Yep, we are in a downtrend so far. All of them pointing in the same direction. Yep, all of them pointing in the same direction, meaning down in this case. Yep, good. There is no crossover whatsoever. No crossover whatsoever. Price nowhere near the 100. It came close to the 100 there. This was a moment of I'm not very sure. Perhaps at this time, perhaps this swing down, once again, it depends how conservative you are, but perhaps we would have been better off letting this swing go and not trying to search for an entry there, just because price got very near to the 100. But anyway, from an overall point of view, we can clearly see that we are, as far as my moving averages goes, and also as far as making lower highs, all right, and moreover lower lows, of course. Okay, have a look at that, how we're making lower highs and lower lows. Well, yeah, we can clearly state that this is a healthy downtrend. All right, now, once again, what do we do in a trending scenario? We keep an eye in the area between the 30 and the 50 simple moving average, which is the one I'm drawing right now on my screen. Alright, and not only that, we keep an eye on that in order to wait for pullbacks to that area. Alright, we have a pullback there, but here it overshot a little bit, farther up, a little bit too much in my opinion, or for my taste. Okay, perhaps, like I say, on this swing down, I would have passed on an entry. But as I was saying before, I'm a conservative trader. I'd rather take less entries. Less entries than other traders, but at least having a higher ratio of winners as compared to losers. All right. In my opinion, there is no need to take every single trade, to trade every single swing or every single trend. In my opinion, there are so many trading signals across the board. There are so many trading crosses, so many currency pairs, so many time frames, that there is always a nice trading opportunity somewhere out there. You don't need to squeeze every every swing out there. If this pullback scared you out because it got too close to the 100 simple moving average, because you got 1, 2, 3 closes above the 50, which is not too many. 3 closes is not that many, really. It's not that bad. But anyway, if that sort of concerned you, just let it go. No worries. You will have another chance later on, and another one, and another one. You know, the markets are going nowhere. There will be trading opportunities all around the clock and all across the board, okay? No matter the currency pair, no matter the time frame. So, like I said, relax. Don't try to squeeze every single swing. If this one, you know, if this one smelled fishy because the pullback was, you know, carried too much momentum, too much strength, and got in the nearabouts of the 100, just let it go. You know, you will have more of them. All right. Alright, let's assume we let this one go. We wait for the next pullback, which happens here, but it doesn't touch the dynamic area of resistance. Alright? Are you a conservative trader? Then don't take this trade. I personally wouldn't have taken this trade. I would have waited for this one. This one, retracement back up. Okay? We reach the dynamic area of resistance. The area of decision taken here, in between this area, is where we have to ask ourselves, will price breach through or will price turn around? If it breaches through, then I cancel or I don't search for entries anymore, just like it did here. Okay? If it goes anywhere near the 100, I stop considering for entries. In the other hand, if it doesn't breach through, if the dynamic area indeed holds the retracement and price turns around and begins to, you know, move once again, to cruise once again in the direction of the main trend, enter short is a high probability trade. Next swing up, okay, another pullback. We reach the dynamic area of resistance. Another decision taking area. What's the chart gonna do? Is price going to breach through and touch the 100, or is it going to curl around in the direction of the trend? If it does curl around in the direction of the main trend, enter short there, man. It's a clear or it's a high probability trade. It is indeed a high probability trade. You are stacking up odds on your favor. You have the trend, you have the optimum area to enter short from, all right? And moreover, you are waiting for the confirmation. That's a high probability thing. You are basically sailing with the wind on your back. Okay, you're moving, you are trading in the direction of the main market sentiment, and moreover, you're waiting for the confirmation that the move is already beginning. You're not trying to anticipate the market's next move. If you enter short just as price retraces back here, then you would be trying to anticipate, to foresee the next market move. All right, that's not what trading is about. Trading is, I always say, one of my golden rules of sensible trading, it's that trading is not about prediction. Trading is about reacting quickly to what's already appearing on your chart. That's why you don't enter short as price reaches up here. You don't take the short here. You wait for the signal that price begins to turn around, and there is where you enter short. You are not, if you enter short as price retraces back to the dynamic area of resistance, right there, you would be trying to anticipate. You would be playing, I don't know, an oracle. You would be trying to become an oracle, a Forex oracle. Like I say, trying to anticipate the next move. That's not what trading is about. You don't want to enter there, okay? Because price just very easily could breach through. You never know, all right? In trading, you never know what the next move is gonna be. That's why trading is not about prediction. Newbies try to predict, okay? Professionals simply try to react quickly enough. When they see the thing, the price turning around in the direction of the main trend, up on a bounce of an area of resistance, bang, they enter short, and bang, they score some profits. When they see the confirmation, bang, they enter short there. bang, they're ready for a new swing down. All right. That's like I say, always remember, trading is not prediction. Trading is reacting quickly. All right, that's all what trading is about. Alright guys, I hope with this video you I've laid out the basic principles of what lies behind the dynamic area of support and resistance, what it actually it's made of, and how I basically use it. Okay, how I basically use the area between the 30 and the 50. All right. Once again, I can't stress enough that if you do not have a trend, the dynamic area of support and resistance is useless. Okay, the 30 and the 50 moving averages are useless. All right. Always make sure that you are in a trending scenario, and then you can begin following price around the dynamic area support and resistance. Not before. If there is no trend, there is no trade. Okay. Alright guys, that's all for this video. I hope with this video you realize of the importance of the dynamic area of support and resistance. It's like I said before, it's one of the main elements of my trading system. It works, okay? It does work. Once mastered, okay, once you've become comfortable enough with the idea, and of course you've taken many demo trades, and you begin to understand those reversal formations of the dynamic area of resistance in a clearly downtrending scenario, they become high probability trades. Trust me, that it's one of my main trading techniques. Reversal formations at the dynamic area of resistance of support in the direction of the main trend is one of my main trading strategies. I will elaborate on those reversal formations on chapter number 3, like I say, but I in this video wanted you guys to understand the importance of, at least as far as my trading methodology goes, at least as far as my trading approach goes, the importance of the area between the 30 and the 50 simple moving average. Alright guys, wow, this video is getting way too long already. I hope you enjoyed it. Of course, as usual, if there is anything from this video that you don't understand, okay, if there is anything about the dynamic area of support and resistance that you quite didn't understand, or that I didn't know how to explain it properly, don't hesitate. I am just one email away. Send me an email and I will get back to you as soon as possible. Alright folks, I'll be seeing you in the next video. Bye bye.